All right, folks. We are live on Facebook. It is the 10th of September. And it is going to be crazy today. I started this day before yesterday. Now, yesterday was a challenging day. I was actually live in an interview. I did a presentation for the Beaver County Chamber of Commerce yesterday. At noon yesterday, and I will get that and share it with you so that you can get the picture, because I talked about the blueprint and actually from the beginning to end of all of the significant pieces of the blueprint, and I will get that and I will put it on here and post it so that you will be able to see that. Now, I'm looking at this day, and what I have is I tried to share my screen day before yesterday, and after I got done and I watched back, it didn't happen. So I put together another montage today, an example. So I really want to get into this 15 and 30 year mortgage thing so that you really understand the reasons why you would be for it or against it and all the opportunities. Now, as we begin every day, we will start our day again with prayers for everybody that is impacted by COVID-19 and all of the loved ones that have been lost, and prayers for those who have lost those loved ones. My heartfelt prayers go out to everybody as we work our way through this. We will get this behind us. There has been other bad things in the past, and we've survived, and we've got behind them, got ahead of them, and got them behind us. So with that being said, I want to get started today. So if you remember, the example that I used was a $500,000 mortgage. Now, I'm going to use Todd Langford. Let me talk about Todd a minute. Todd Langford has been a friend, a mentor, a coach of mine for nearly 30 years. When I started 44 years ago and way into that in late 80s, I got involved with an organization that had a program called LEAP, L-E-A-P. I'm still involved with that, and I use their material to help me educate clients and people that I meet through my presentations. So all of these things are nothing more than tools. And the software that was created around that program, and that program was amazing, was created by Todd Langford and his mentor, a guy named Norman Baker, who has now since passed away. God love him. Norm was he was a genius type of guy with finances. He was from a place called Nacogdoches, Texas. And he was just an amazing guy. So I have known Todd all these years. He has a software today that he has created and has used a long time. It is called Truth Concepts. Now you can find it, go to truthconcepts.org, and you can actually download the software and use it for 10 days for free. And so it will give you a feeling. Now I'm going to share with you today some screens from his software as we evaluate this 15 and 30 year mortgage comparison that we're trying to do. And I believe we will accomplish it. We will finish it up today. And then tomorrow's program, I'm going to get into pay downs. And we'll talk about that. Because these are the two biggest things that I believe are strategies that are really, really important in our lives to stay in control of our capital in every way, shape, and form that we can. Because remember, when we look at the financial world that we do business with, the typical advice we receive coming from the financial world is simple. They have 4 basic rules that they have, and they want to simply be in control of our money. I want all your money. I want more ongoing. I want to keep it forever and give back as little as possible. Now think about that. All that really means is it maximizes the profits that the financial institution can drive off of your money. If you think about that for a minute, some of the biggest things we're told to do with our money fits that pattern for the banks to the T. 401k, IRA, all of those things. I want all your money. I want more ongoing systematic payments. I want to keep it forever and give back as little as possible. Doesn't that absolutely fit 401k, IRA, 403b, 457 plans, and pension plans, profit sharing plans? They all fit that category. Because when you get to retirement, are you going to take lump sums of money out, give it all to me, and pay all the tax at one time? Because of the tax impact, you're going to take it out in dribs and drabs over a long period of time. The presentation I made yesterday, we talked extensively about 401ks and tax qualified plans that allow you to postpone the tax on your money until some future date. And they lead you to believe, because the sales technique, and I remember 44 years ago when I started, we sold IRAs. Oh, you're going to be in a lower tax bracket when you retire. Well, guess what, folks? The only way you're going to be in a lower tax bracket in the future is if you're dead broke. Now, if that's your plan, I can't help you. If your plan is to be square in the middle of the acceptable level of mediocrity, God bless you. It's all yours. But if you're looking to maximize the well-being and the financial future that you have control of, then that's really what I'm all about. So those are the 4 rules of financial institutions. Now, the 4 rules of the Financial Mastery Blueprint: save 20% of your income. No more than 5% of that, 1/4 of that, goes to 401ks if you're getting a match. You want to accumulate 50% of your household income in accessible capital. That way you never have to have credit card balances and risk paying a credit card company 18 to 27% interest on the money. And then the third one is no consumer debt. You learn to be the bank. You take over your consumer debt. When you pay cash for something, you pay yourself back with interest, so you capture the opportunity cost that would normally have been lost, because you cannot afford to have $1 less than the most you can have at some future date that you would refer to as retirement. And I've said all along, retirement is like a myth. It's not listed in the Bible anywhere. So I tell people, don't plan on retirement in the way that you think. Now, if you have a physically or a mentally demanding job and you got to get out of it, I understand that. But you've got to remember, you cannot lose being connected to some way to make money even after you retire. Because we don't know when the federal government, the US government, that debt and everything is going to blow up, and they're going to come after us in an enormous way in order to cover their rear end and cover the interest and the debt that they're running up beyond everybody's ability to pay for it. So I don't know how that's going to turn out, but all I know is you need to stay in touch with some way to make and earn money even after you've retired from your physically or mentally demanding job. And if you don't have a physically or a mentally demanding job, then maybe you want to consider part-time or staying connected to it in some way ongoing, because that unknown thing that's sitting out there is huge. It is huge. So those 3: save 20%, 50% of your income in accessible cash, no consumer debt. That's number 4. Number 4 is the graduation to the CFO at home. And it's where you look at your money in a very, very different way. You've now learned how to think differently. And because of that, you see things differently. You have now learned how to measure properly. And that's really what I'm going to share with you today with this PDF, this stuff I'm going to show you today. And we're going to get to it here in a minute. But I just wanted to cover the ground rules of really what we're trying to do in doing that. So now, I'm going to bring this thing up on the screen. Hopefully, I'm going to go over here and find the share. Where's the share button? Got to find the share button. going to bring this back over here. Okay, where's my share button? You know, I just love this, and I really. There it is. I have found it. So let me go down here, and I'm going to share the screen so we can see this PDF. Share screen. There it is. Share. Now, you should be looking at my screen. It says Prosperity Proof number 2, choosing the right mortgage. And I hope you're out there and you're seeing this as we're looking at it. And very simply, it says when choosing a mortgage loan, it's essential to look at all the facts. So as I go down through this thing, 15-year mortgage has appeal of a quick payoff, but is it better than a 30-year mortgage? So now we're going to look at 30-year mortgage starting to sound pretty good, right? And let me go back up and look at what it's saying down here. 15-year mortgage has quick appeal. We're going to go down here, comparing mortgages. Now, a client is buying a house for $250,000, needs a loan of the same value. Both mortgages, the 15-year and the 30-year, we're going to use the same interest rate, 4.5%, at the bank of his choice. If he goes for faster repayment schedule, his monthly payments are $1,912 a month. 30-year mortgage, the payments are $1,266 a month. So if I look at these two things and I look at them, and I said this Monday or day before yesterday when we looked at this, you know, the 15-year mortgage, obviously, if you look right in the middle of the page, is going to have less cumulative cost of loan, $344,247, 30-year mortgage, $456,017. Now, we're going to analyze this because, you know, you look at that, and the other day I talked about opportunity cost, et cetera, and that's really what we're going to do today with some calculators, and these numbers are on the screen. So I'm going to slide this down. So there's the schedule of all the payments. What's going on the two mortgages. On the left side is the 15-year mortgage. On the right side is the 30-year mortgage. Shows the client comparison. We use the loan analysis as one of Todd's calculators. And again, you can download this software at truthconcepts.org. So now, if the client wants to pay it off fast, wouldn't it make sense that he might want to pay cash for the house? So now we're going to assume that he pays $250,000 cash for this house. And we're going to use the same interest rate of 4.5%. So 360 months, 30 years from now, that $250,000 is going to be worth $961,925. Now, what am I saying with this? I'm saying that if you pay cash for the house, you better hope the house is worth $961,000 in 30 years. And I don't know if the house is going to appreciate 4 times in 30 years. I mean, I've been around a long time and have houses, but there it is. So you've now given the bank your potential to hang on to your $250,000, and in 30 years, it would grow to $961,000. Now, okay, Tom, I don't have the $251,000, so we're going to make payments. So here's the 360 payments. Now, this is where I'm going to really get you between the eyes, because now I've got a $1,266 payment monthly and 71 cents at 4.5% interest for 360 months. Gee, isn't it interesting that my payments accumulated at 4.5% interest would have the same value, $961,924, as the $250,000 in cash accumulated for the same period of time? Do you see what I'm showing you? So where is your betterment? You've given up control of all of that capital by paying cash for the house. Now let's go another step. Now let's go to the 15-year mortgage. Okay, and at the end of 180 months, 15 years, your payments, if you would have put them away and saved them at 4.5%, would be worth $490,388. But that's only 15 years, so that's that value. Now we're going to take that value and we're going to compound that for the next 180 months. And gee, guess what? The future value of all of those payments in 30 years is still $961,924.51. So folks, I hope you're seeing this, because what really happens here is saving the difference. If you take the difference between the 15-year and the 30-year and you save it for 360 months, there's $490,389 that you would have by saving the difference for the 30 years. So what does that mean? It's like in the 30th year, if we look at the present value calculator, we can see that the last payment is like $515 at 30 years. A 15-year mortgage won't get inflation benefits like that. So you got a $1,200 payment in the 30-year mortgage. There it is, $1,266 on a 30-year mortgage. At historic inflation, the last payment has a value of only $515. There it is right there. So the end value is $5. So the last payment you make is like paying $515 today. So by accelerating the mortgage, you lose that value, that economic inflation value that comes to you. Now, let's take it another step, and there's that difference in the payment, the 3% average inflation. So there's the calculator. So let's look at some 15-year myths and as we round this thing out today. Equity increases the value of your home. No, it does not. Your value, your home value, is going to do what it's going to do. It's going to increase or decrease based on the marketplace. The mortgage has nothing to do with the value and equity in your house. More equity increases the owner's financial strength and provides more control. How does that? Are you guaranteed the bank will always loan you money against your home? I mean, how many factors go into that? Then the other side of that, tell me the interest rates are always going to be favorable to making a loan. Safer risk position from cash flow reduction issues, loss of job, disability, and emergency. Well, how does that help? You have a higher payment on the 15-year mortgage, which would be harder to make if you lost your job and didn't have, income. Cumulative interest paid is the cost of the mortgage. Guess what? It's really the same on either mortgage, but you give up control of that cash. When we talked the day before yesterday about this 30-year mortgage, at the end of 15 years, you still had enough capital, by saving the difference in the payment, that you could have paid off the 30-year mortgage if it was the economic correct thing to do. And that's really what it is. So here's the reality. Higher equity reduces the loan balance, but does not affect the value of the house, which is determined by the market. I just said that. More equity causes less negotiating strength with the financial institution. To access that equity, you must sell the home or qualify for financing to borrow against it. So that equity in a home is there, it's on paper, but it doesn't mean that it is actually something you can use. Extra equity can cause the loss of the property due to a reduction in the amount of available cash outside of the house for emergencies. You cannot always turn the value of the house into cash. Total payments minus the tax deduction compounded at a compound rate is the real cost. So with all of this to consider, a 30-year mortgage seems like the right way to go. It keeps the clients in control of their asset and their home, provides the option to keep money where it's liquid and accessible and not locked up in home equity. Now, if you would like this PDF that I've run here, if you would like that, there's Truth Concepts. Start your 10-day free look. You get a 10-day use of it without paying. You can always cancel it out and not pay for it if you want to do that. But if you send me an email to firedupt, FIREDUPT at Comcast.net and ask for the mortgage comparison PDF, I will send this to you in an email and you can read it for yourself, because this is the truth. This is what the financial world does not want you to see or to understand, because remember, they want all your money, more ongoing, keep forever, give back as little as possible. And they want the payments to be as big as they can be so they get their money back quicker. It appears to me that this is not in your best interest to get a 15-year mortgage or refinance your mortgage to a 15-year mortgage. I don't know. I'm about helping you create wealth in the most efficient, expedient way. That's really what I'm all about. So I'm going to stop sharing. I find my little guy here and come back here to us. So there I am. So here we are, and we're back. So I want to wrap up today, and I want to remind you, you can get my book, The Family Money Farm, The CFO Project, Barnes & Noble, Amazon, any big bookseller, there it is. Or you can send me an email and get it from me. You can use firedupt@comcast.net or Thomas Young at 1stconsultantsinc.com. Or you can message me through Facebook, through this site. And I will send you an autographed copy, and we'll pay for it through PayPal. I'll send you an invoice. You can do that and pay for it. But that will get you my book. The book has all of this in it. The book will change your financial future. You know, when I meet people and I show this stuff to people, they all say the same thing. Tom, I wish I'd have met you 30 years ago, 20 years ago, 10 years ago. Well, I don't have a time machine. We can't go back. But what I can help you with is, let's change the ending of the story. Let's better the ending of the story. Let's create some real wealth, some real equity, and some real benefits for your future and your family's future, the next generation and the next generation. I challenge you to be the catalyst. You be the catalyst to make a difference from this day forward. And it takes a decision. I'm going to make a decision. I'm going to make a difference in the rest of my family's history. I'm going to start today, and I'm going to make a difference. That's what I challenge you to do, folks. Accept the challenge to make a difference in your financial future that will impact not only you, but your children and your children's children. That's what this is about. Because the thing in Washington, I can't fix it. It's not going to go away. But sooner or later, the dam is going to break. And when it breaks, all heck is going to break loose. Yeah, I didn't say it. Hello. All heck is going to break loose. So with that, I want you to go to cfo-project.com. Put in your name and email address. You go there, and you can actually get my other book, Life Insurance, Will It Pay When I Die? And now when you go in there, I'm gonna encourage you to spend and invest $47 for your benefit. There are 4 books there, plus a 1-hour video that will change your life. A book by Kim Butler. That's Todd Langford's wife, by the way. Live Your Life Insurance. Understanding that this unique product that is only available in less than 1% of the entire marketplace. And your odds of finding this out is 1 in 1,000. because there's 850, 900 companies out there selling life insurance, and there's only 10 or 12 of them or so that actually offer the right kind of product that has a rate of return in it, and you become part owner of the insurance company. If insurance companies weren't profitable, why are all these other corporations created to make money in the insurance business? The life insurance business is the most profitable business on the planet with certainty. And the mutual companies have all been in existence for more than 100 years. So I guess they've been through some really bad times in history. And guess what? They're still there. They're still doing what they're doing. And they're all very, very financially sound. So with that, invest in yourself. Send me an email, send me a text, and send me a note on Facebook. Let me know what your thoughts are. Am I helping you in what you're doing? Let me know. I would really appreciate it. God bless. We'll see you tomorrow, and we're going to talk about pay down strategies tomorrow, and I will have some more excellent content like I did today. So we're done.